Good morning, everyone, and welcome. My name is Roshan Kanesan. I'll be your MC for today's event. First and foremost, I'd like to extend a warm welcome to our esteemed hosts. We have Tan Sri Abdul Wahid Omar, Chairman of Bursa Malaysia, here with us, of course, as well as Datuk Muhammad Umar Swift, CEO of Bursa Malaysia. Gentlemen, thank you for hosting us here at your offices. Of course, a warm welcome to Malik Ali, founder of BFM Media as well. I know he hates it when we mention him like that. I am sorry, boss. As well to all our delegates who are present here today. Thank you for braving the rain and joining us today. And apologies for the slight tardiness there. The rain changes all sorts of things when it comes to getting to places. Now, thank you for joining us for Strategic Crossroads, the US elections' impact on Malaysia's growth trajectory, proudly organized by Bursa Malaysia in media partnership with BFM Media. Now, no surprises here. We're going to be diving into the US election and its ripple effects, let's say, with the US presidential election now settled. We're looking at a second Trump presidency emboldened by a red Senate and what is likely going to be a red House of Representatives that hasn't been officially called just yet. US elections have far-reaching implications from markets to economies, and today we're going to be diving into all of that, and especially with a focus on what it means for us here in Malaysia. We're going to be hearing from top experts as well as industry leaders on how possible shifts in US policy might have impacts on Malaysia's own growth trajectory. To kick us off, I'd like to invite Tan Sri Wahid Omar, Chairman of Bursa Malaysia, for his welcoming remarks. Tan Sri, over to you, please.
Well, thank you, Roshan. It's good to see you in person instead of just hearing your voice on BFM. And likewise, good to see Xiaoning as well. Later, she'll be appearing. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. And very good morning, Encik Malik, members of the board of Bursa Malaysia, friends from BFM, industry players, corporate captains, distinguished guests, ladies and gentlemen. Assalamualaikum warahmatullahi wabarakatuh, and very good morning to everyone. Welcome to this special edition of Invest Malaysia 2024, the US election impact on Malaysia's growth trajectory. Well, I'm sure everyone has been tuning in to the outcome of the US elections just a few days ago. We are indeed in for some exciting times ahead. Exciting inverted commas. Now, a lot of us holding our breath for the time the president-elect will get into the office, and his return and policies will undoubtedly have significant implications for Malaysia, the Asian region, and of course, even the world, given the influence of the US. Now, following Trump's election, the US-China trade war is expected to intensify. Many analysts have predicted economic turbulence in Asia as businesses across the region prepare for increases in American tariffs. Some have speculated to be as high as 60% on all China imports. Now, this was very much based on the points that President-elect Trump made repeatedly during his campaign. And his return also adds a further layer of uncertainty for countries like Malaysia, which continue to balance their relations between the US and China. Ladies and gentlemen, the sheer size of the US economy, with a projected GDP size of $29 trillion for 2024, firmly positions the economic powerhouse as one of Malaysia's largest trading partners and foreign investors. In 2023, the bilateral trade with the US accounted for 250 billion ringgit, representing 9.5% of Malaysia's total trade. And Malaysia remains as the 19th largest trading partner for the US and the fourth largest trading partner among the 10 members of ASEAN. For the first 9 months of this year, our total exports to the US surged by 18% year-on-year to 140.48 billion ringgit, accounting for 13% of our total exports. And this makes the US as our second biggest export market after Singapore. And the US climbed into second place after overtaking China in the same period last year. And during the same period, our imports from the US also rose significantly by 49%, reaching 94 billion ringgit, ranking US as Malaysia's third largest source of import behind China and Singapore. Now, in addition to that, the US stands as our third largest source of foreign direct investments, with total approved investments reaching 21.5 billion ringgit in 2023. And notable investments from American technology giants, including Google, Microsoft, and Amazon Web Services, emphasize Malaysia's attractiveness as a hub for innovation and development. And these investments not only bolster our economic growth prospects, but also foster technological advancements and job creations across the various sectors. Malaysia also stands as the world's sixth largest exporter of semiconductors, accounting for some 7% of the global semiconductor trade and 13% of the market for semiconductor packaging, assembly, and testing. And in recent years, the semiconductor sector has benefited from the US-China trade war, and additional tariffs after the US elections could further enhance this momentum. And in terms of currency implications, the US dollar and the SWIFT system that facilitates secure and efficient international transactions are essential for Malaysia's global trade and investment activities. Some 80% of Malaysia's annual trade, totaling some 2.8 trillion ringgit, is denominated in US dollars, and this reliance makes Malaysia sensitive to fluctuations in the dollar's value, impacting exchange rate stability and economic health. And additionally, a significant portion of Malaysia's foreign exchange reserves at 117.6 billion US dollars is held in US dollars. Now, ladies and gentlemen, as you can clearly see from the statistics that I just mentioned, the US has a profound impact on Malaysia's economy. The ongoing geopolitical landscape, particularly the US-China trade war, presents both challenges and opportunities for Malaysia. However, as our government would continually emphasize, Malaysia maintains a neutral stance and balances our relationship with both powers. And to this end, Malaysia has adeptly positioned itself as a neutral player, allowing us to benefit from shifts in global supply chain while fostering a robust partnership with the US. Now, as businesses seek alternatives to navigate the complexities of international trade, Malaysia has successfully promoted itself as a viable and stable regional hub for manufacturing and distribution. And this strategy has resulted in a notable influx of foreign investments, underscoring Malaysia's capacity to adapt and thrive amid the challenging global dynamics. And to this, Bursa Malaysia has actively facilitated Malaysia's appeal to attract investors. And our Invest Malaysia series, in particular, is designed to enhance Malaysia's profile to global fund managers and institutional investors. And since our first Invest Malaysia back in 2005, we have conducted some 32 Invest Malaysia editions in Malaysia and 60 Invest Malaysia Away editions in major financial cities around the world. Distinguished guests, ladies and gentlemen, the reason many of us are here today is that we recognize that the US election result has a vast impact on our capital market and economy. In fact, as the election results were unveiled, and as to be expected, there were immediate movements in various indicators of different assets, from currency to stock indices to derivatives, gold prices, and even, of course, the volatile non-asset-backed instruments such as Bitcoin. Now, our discussions this morning will shed light on these complex dynamics, beginning with insights from our friends from JP Morgan, Rajiv Batra, who will discuss the impact of the US election on global markets and US-Malaysia relations. The analysis will help understand how these shifts may influence our economy and provide a strategic outlook for Malaysian businesses navigating a post-election environment. Thereafter, we have our CEO, Dr. Umar, who will delve into how the latest US election results will be shaping equity strategies and financial markets with a focus on sectors impacted by these developments. And later, we will have a session delving into shifting tides of US industry policies and its impact on Malaysia's semiconductor industry, assessing which local players may stand to benefit from these changes. And for that, we have Wong Chang Ning to moderate the session. So in closing, I would like to encourage all of you to stay tuned, so to speak, and participate actively in the deliberations that we will have later. And I certainly look forward to listening to the views of all the experts that we have later. Thank you.
Thank you, Tan Sri Omar, for setting the stage for us for the rest of the day, giving us a lot of context through a lot of those numbers, particularly the trade numbers, and Malaysia, how Malaysia is trying to navigate all this, right? It's going to be an interesting and exciting time ahead. Ladies and gentlemen, thank you once again for braving the rain and joining us here today at Bursa Malaysia. A quick recap for those who've just joined us in the room. With the US presidential elections now settled, we're looking at Trump 2.0 backed by a red Senate and what is the possibility and expectation of a red House of Representatives. And as Tan Sri mentioned, the elections of the most powerful economy in the world will have far-reaching implications on a whole range of economies, including ours here, and we're going to be diving into all of that through expert analysis throughout this entire morning, including how shifting US policy might impact Malaysia's economy. A few reminders before we kick off the expert analysis side of the equation. For those who need Wi-Fi, the Wi-Fi network is guest, and the password is market at 1818. That's market with a capital M at 1818. And we're going to be using Slido for Q&A, which is going to be especially important for the next session because Rajiv, we can hear Rajiv, but Rajiv will not be able to hear us. So input your questions into slido.com 3971256 or scan the QR codes in front of you. I'd like to remind all the attendees that we are at a full house today. We've got a few remainder seats here, so don't save seats for anyone else in case they come in. Make it easier for other people to come and join us. Now, on with the shows. The chairs are here. We're ready. The stage is set. Next up, we have a presentation from Rajiv Batra, Head of Asia Pacific, ex-Japan and China, Equity Strategy at JP Morgan. As mentioned, Rajiv will be joining us via Zoom to discuss his post-election equity strategy and the anticipated impact of the US election on global and regional markets. I now pass the stage over to Rajiv.
Good morning, everyone. Thanks for joining us for this session today. Myself, Rajiv Batra. I'm head of JP Morgan Asia, ASEAN, and India Equity Strategy. And I'm also the co-head of Global Emerging Market Equity Strategy in JP Morgan, being part of this company for the last 2 decades. So, former President Trump won the US presidential election last week. With this, the red sweep policy outcome are now in play. And investor focus have shifted to the potential sequencing of US policy priorities. A key determinant to this sequencing will be personnel choices. While the market has some experience with Trump's biases and VP-elect J.D. Vance's public statement, there is lots of room for policy influence that can come from key cabinet ministers like State Department, Commerce, Treasury, USTR, Defense, and a potential new government efficiency department. Overall, the early days of the next administration may focus on executive authority related to immigration, energy permitting, and deregulation. Together with this, given the decisive mandate won by Trump, it looks increasingly likely that the tariff plan may be outlined very early in the next administration for industry comment and negotiation, an escalate to de-escalate playbook which we are hearing about, while stimulus measures arrive only later part of next year. President-elect Trump has threatened to hike tariffs on China imports to 60% and tariff on global ex-China imports by 10%. While JP Morgan thinks the odd of a 10% across the board tariff in 2025 are very low, in part for the procedural reasons. The probability of a significant tariff hike on China imports have increased significantly. Taking this into account, we revisited our growth, inflation, and monetary policy assumptions for next year. And hence, China have seen GDP downgrade in our JP Morgan growth forecast from 2025 from 4.6% next year to now 3.9%. For Asia, equity markets are thus likely to start pricing in the drag from tariff once implemented beyond what has already taken place. By sectors, renewables, healthcare, auto, consumer exporters are likely directly in the line of fire. Remember, during the first trade conflict, that is from March 2018 to October 2019, we note that China and Korea were the worst performing market, while India and Taiwan proved more defensive. By sector, trade exposed auto, material, healthcare, and industrials did poorly, while defensives like utilities, staples, and telcos did very well. While tech is highly exposed to trade too, but it held up relatively better. Tariff on tech exports may be more nuanced given the lack of geographical alternatives to the leading edge supply chain, both for devices and for semiconductor. And on export restriction, the new US administration may prefer a big yard low fence or over small yard higher fence approach on tech space. As a result, key tech companies may actually end up benefiting from margin expansion due to dollar strength without losing much on the top line. Unlike in the first trade conflict, trade rerouting via ASEAN or Latin America is likely less of a thing. But this time around, given the heightened focus of the US administration on this channel, it will be concerning for us. But at the same point of time, what we are seeing now, front loading of order is already underway to front run potential tariff and other restrictions, which will be benefiting exporters and transportation sector near term basis. Within China and Hong Kong equities, which is in the ring of fire, the Trump trade has favored locally focused business with the goal of achieving self-sufficiency. For China listing, outperformers were IT localization, that is your semiconductor, hardware, and software companies, brokers because of rise of their local equity market due to all the stimuluses and supports which we are seeing, lower beta spaces, and most importantly, high yielding defensive. But at the same point of time, there were lot many underperformers also, high beta names, exporters, and especially business with the global revenue lines. Among other sectors potentially impacted by US policy will be energy sector, which is also important for our region and country too. So rising US supply may put downward pressure on oil prices, hurting Asia's upstream energy stock. Ironically, renewable energy and green sector, which include battery material, may be equally negatively impacted if IRA provisions are going to be rolled back. Expectations of upcoming inflation due to higher tariff, lower immigration, and larger fiscal deficit is also likely to push rates further higher, which will be supportive of the bank's earning in our region because NIM contraction pressure or rate cut leading to NIM's contraction, that story may get over in this higher rate regime. From a geopolitical perspective, the impact of Trump administration on risk level currently is uncertain. Now, China hawkishness is no longer a new, and the use of unilateral restriction has also become a status quo. A lot will then depend on the makeup of Trump's cabinet. While a new Trump administration raises uncertainty about geopolitical relation and tariff will bring retaliation, it is also the case that the Trump 1.0 administration was less ideological about adversaries, leaving room for some negotiation. Now, all in all, when we look at the stuff which I presented to you, we have used our multifaceted assessment of election outcome impact, which includes how EM Asia asset classes impacts via the dollar and the rate move, earnings impact both at the macro and micro level, translation from US equities move, that is risk on or risk off, changes in geopolitical risk premium, and finally, sector-specific impact via various regulation, either in biotech, chips, IRA, or multiple other industries. In that sense, India and Taiwan look more defensive, while China, Korea, and ASEAN appear more at a risk. Talking about ASEAN markets, we are already going through a phase of significant volatility post the US election. Heightened odds of this US China tariff war next year will going to have a differentiated impact across the ASEAN region. During 2018 and 19 trade war period, ASEAN markets were down by 5 to 25%. However, some domestic driven markets like Indonesia and the Philippines were the best performer. So how does tariff war will impact ASEAN region overall? It could happen through various channels. Like number one, if China growth is getting impacted, as I've highlighted, JP Morgan reduced next year growth estimate from 4.6 to 3.9. So that will lead to lower exports to China. Second, if China is suffering because they have an excess supply, demand is lower, you may see redirection of China excess capacity, which makes domestic business in our part of the world incompetitive due to dumping. Third, lower exports to the rest of the world amid the sharp CNY depreciation. The year-end forecast for CNY from JP Morgan next year is 7.5. But in case if tariff arrives, there is a risk it can move upward and go to 7.75. And in a very neutral zone, like if we just extrapolate the amount of tariff being imposed on China by 60%, and vis-a-vis if China currency needs to react, a sensitivity analysis if we run, then CNY can even go to the 9 handle also. That is not the JP Morgan is forecasting, but just extrapolation of if tariff can be translated into how much currency should be depreciated or devalued. That's how CNY depreciation can impact the rest of the world exports. Fourth point is the tighter global financial condition, which should induce less monetary easing. I hope you are already seeing around with many houses and consensus coming out and reducing their cuts estimate for emerging market Asia and some of the ASEAN countries also. To protect the currency, that could be the criteria in a situation when the global dollar financial conditions are tightened, that you may not be able to ease as much as is needed. Last but not the least, a general paring back of business and consumer confidence in domestically in the market, because end of the day, ASEAN is a big trade hub. So if the global trade get impacted due to the tariff war and global trade growth turns negative, that will put a dent in business and consumer confidence of our region. So when we look at the growth impact, individual country-wise, it is likely to be very differentiated across region based on the exposure of each economy. So some economies are much more exposed and will see a significant growth shock in 2025. Vietnam taking 1.2% growth shock, Singapore 80 basis point growth shock, Malaysia 80 basis point, and Thailand 70 basis point likely at the top of that list. To be sure, this presumes the US crackdowns on transshipment flows from China and potentially implement sanctions against China value-added element in ASEAN production chains. This would also put pressure on 2025 earning growth estimate for this market. Right now, when we look at this number, GDP has started pricing in the risk, but earnings of 2025 have not been revised down yet. So that's the other leg from where the risk will appear. With the US exceptionalism continuing and higher for longer inflation and interest rate scenario, JP Morgan FX and rate team sees 7% upside on US dollar and a 40 basis point increase in the US 10-year bond yield under the current scenario. Near term, this may not bode well for twin deficit markets like Indonesia and Philippines beyond what has already taken place so far. So question comes for some of the fund managers and even strategists like me, how to allocate money in ASEAN. Yes, you may not be able to take a very clear-cut country call because you have some other problem to manage. But sectoral way or a thematic way will be the best way to approach. The first will be banks, stocks who are geared to the higher rates and a steeper US yield curve will benefit. Second, sectors and stocks with the positive USG revenue and asset exposure and being important part of the global supply chain will benefit, like the Malaysia tech space. Third, we expect defensive domestic-oriented companies to outperform over the medium term, given their growth is more driven by domestic versus international driver. At the end, in long term, there remains question about potential circuit breakers on US rate and US dollar. Rates move could go non-linear if market concerns about US fiscal spending escalates. Another area of long-term musings is about geopolitical alignment and whether Trump's trade policy and America's first thrust ends up bringing other foreign parties close together, particularly in the global south region. With that, let me take a pause and start going into Slido and see what questions are coming up and answer you for that. So the first one is, what are the exchange rate, USD CNY and US tariff assumption leading to JP Morgan projected China GDP downgrade of 4.6% to 3.9%? So as I've highlighted earlier, the CNY assumptions we are having for year end next year is 7.5%. And the tariff assumptions where China is already paying 90% at this juncture, we expect it to increase 60% and will be implemented in second quarter and third quarter potentially of next year, which means you may see 6.9% GDP growth current quarter, 5.5% first quarter, but second and third quarter of 2025 being weaker. And that takes your entire 2025 GDP growth through 3.9%. Now, this 3.9% does not take into account if any trade deal is being stuck or if there's a truce between China and US in some sort where China agrees of some inward investment into the US. And because of that deal struck, not only they get the higher charge of tariff, but even the current tariff of 19% can little bit get reduced over there. So hence, we are not taking that positive estimate into account, but the clear risk is the 3.9 can even slip below further if sooner there is not some consensus or a deal between the US overall. The next question comes, do we expect US to impose greater security on ASEAN or Malaysia owing to trade diversion on China plus one strategy? US done it recently for solar panel with tariff up. This is a key concern which we are also having, but there is no color yet that how they will target either the global tariff or the transshipment tariff, because at one point of time, if you try to impose saying the X sector on the transshipment tariff side, but some of the smaller SME industries which are providing much more value locally in ASEAN countries or even in Malaysia side, they will also get unnecessarily punished. Now, some places where it's only relabeling happening, as the example being given over here of solar panel, where solar panel is being imported from China and just get relabeled as made in ASEAN or any other country. then definitely it is easier to tariff them. But when you talk about global tariff of 10 odd percent, which we have never seen happening beside 1971 under President Nixon, under IEEPA, it's difficult to assume how it will come. But we do believe chances are high, and due to this reason why we even downgraded GDP growth estimate for ASEAN countries also, as I've highlighted, particularly in the trade havens like Vietnam, Singapore, Thailand, and Malaysia, because we worry, along with China, even ASEAN can come under risk for sure. The next question is, how will the US election influence regional trade agreement like CPTPP or even ASEAN? As I've highlighted, initially, Trump will look forward to go with the executive authority order rather than looking a legislative route to impose tariff. So the easiest one for him is to put China tariff, because that can be done through executive authority order. But in case he wants to go with a global tariff, which actually challenge the free trade agreement US is having in our part of the world, individually at a country level or even at a regional level, that can become null and void. And most importantly, most of the traditional Republicans are pro free trade. And remember, as I've said earlier, Trump 2.0 administration value alliances. They value free trade overall. That is the reason why it will not be easy for him to pass the global tariff through executive authority order until unless, as I've said, he invokes IEEPA, that is International Emergency Economic Power Act, which was implemented by President Nixon back in 1971 when US was going through BOP crisis. You need a valid reason to do that. Otherwise, legislative will be route, which looks difficult due to the procedural reason near-term basis. The next question is expectation for USD to Malaysia ringgit under the Trump administration. As I've highlighted earlier, we do anticipate 7% dollar moving up from current level. But in case of Malaysia, we are much more sensitive to Chinese yuan compared to dollar. So we, over the last 5 years, the probability or the correlation of Malaysia ringgit with Chinese yuan is close to 60 odd percent. So the much more worrying sign for us will be how Chinese yuan react. If Chinese yuan depreciates to 7.5 or worst case even 7.75 level, along with that, most of the emerging market ASEAN countries also need to move their currencies to keep that export competitiveness with China, will lead to similar amount of a depreciation. So taking that into account, if CNY forecast from year is another 5 odd percent depreciation, so that puts even Malaysia on the same spot from current juncture. The next question is, do you see the possibility of China distributing its trade to the nations ex-US to mitigate whatever headwinds from Trump policies? That's one potential question even I'm facing from majority of investors, because with Trump's America first or more isolationist kind of policies over there, people are doubting the bigger nation in the world whose job is to provide their current account to the rest of the world so that globalization and business flourish, and at same point of time give the protection umbrella in terms of subsidized defense, arms, and other support. If that goes away, we will need some other region to emerge and start providing in support. That's the reason why I highlighted we may see much more regionalized world rather than one country taking the heavy burden, what US have been doing. You can see the emergence of global West, global East, and global South. In that, one big country can emerge over there and start supporting. So we have seen in the last G20 where India was trying to portray as a key leader of global South. But to prove themselves to become a global South leader, they will need to provide their current account and even the defense support to all the neighboring economies across. Does India have that kind of a prowess at this juncture? Maybe, maybe not. But does China have it? Yes, definitely. But at same point of time, we need to recognize China is also going through growth troubles, and they themselves are trying to stimulate economy. Once things get in order, maybe that can be the criteria to watch. We are getting close to the closing time, so I will take two more questions from audience. So what do you think China will do in retaliation should US impose a widespread tariff? So we do believe that the pitch book will be exactly similar like last term. Rather than being proactive, China will try to be much more reactive. As an example, we saw red sweep happening. Then the next move come close to 10 trillion renminbi of support package from China. Now, if in the next round the tariff get announced, maybe we will see much more dry powder coming out from China side to support their consumption and reviving the domestic demand that can counter or offset export slowdown China can see. So we can see a lot of quid pro quo stuff keep on happening in a typical game theory manner. But people or investor whom I talk to do actually worry about that. Can China impose, and ask me this question, can China impose a blanket ban on critical mineral or rare earth mineral export to the rest of the world just to show the export competitiveness, or China can whatever depreciation like tariff are being imposed to that, can they implement an equivalent amount of a currency depreciation also, which I've highlighted, like if you extrapolate 60% tariff, then the currency CNY based on the model should you go to even 9 also. But that are not the option China will go with. China will follow with a very tactical move with in terms of a dealing. And remember what we are hearing from even from the US Trump 2.0 administration also, their pitch book have been number one tariff, number two deal, and if the deal doesn't happen, then you can go with a situation like confrontation. Remember last time in 2017 to 2019 cycle, first thing was a deal and support packages coming through, then tariff came, and then during COVID time confrontation happened. So they have rejigged the sequencing, and that's the reason why I said sequencings of event are going to be very important, and that is going to have impact on the market. I'll take one last question. I know there are a lot of questions coming through. Thanks for that. But at the same point of time, we are near the closing time. So is there a material expectation that tariff will slow down the Malaysia economy through lower demand and consumption? That's where I will differ because we have seen last time around, beside India and Taiwan during the trade war one, Indonesia, Philippines, and Vietnam also emerged as a winner. Now, we know Indonesia known more for commodity, Vietnam known more for tech and exports overall. Philippines known as a big commodity importers and get impacted by dollar and rate movement. Why they still able to have their head higher and outperform in such environment? It is all because of government policies, fiscal policies, and this time around, Malaysia is in that particular fiscal spot, like fiscal support from government. So if we look at Prime Minister Anwar Ibrahim policies, he is being too pro-growth overall, trying to revive the domestic engine, try to support the investment demand in case of Malaysia. So that will be helpful in offsetting any kind of an export slowdown coming. As I've highlighted earlier, in case if there's a tech sector, the tariff will be very much nuanced, and you cannot expect that tech sector goes vertically down when the tariff wars start happening overall. Tech being the key in case of a Malaysia, and important for both mainland China as well as US as a strategic location, that's where Malaysia will still tend to key to benefit overall. So we do think with the kind of pro-growth policy, fiscal support, and even BNM central bank support, Malaysia this time around could even emerge as a winner during this trade war too. With that, let me take a pause and hand it over back to Roshan.
Rajiv, thank you so much for your insights. And I think a lovely note to end on as well, a little bit of optimism in what has largely been concern. But ladies and gentlemen, that was Rajiv Batra from JP Morgan. He is Equity Strategy Head of Asia Pacific, ex-Japan and China. We now move on to our first panel discussion of the day, new White House rules that send ripples to local shores and equity strategies. New policies from the world's biggest economy will likely impact economies in the region and spill over into Malaysia, as Rajiv was just talking about a little earlier. Our panel of experts here will discuss how the US president shapes global economies and regional economies as well, and how Trump policies may impact economies in the region. Now, before we dive into that, I did see a few new people enter the room, so here's a few quick reminders. Wi-Fi login details, let's start with that. We first start off with the Wi-Fi network name. It's guest, very easy to find. And the password is market at 1818. That is market with a capital M at 1818. Also, please take note that we'll be using Slido for Q&A. Please go to slido.com and insert the code 3971256. Again, that is 3971256. And just like what Rajiv did earlier, he's going to be taking questions from that. Our guests will be taking questions there as well. If you don't want to type all that stuff in, just scan the QR code.